Welcome everyone. My name is John Mark Young and this is the Whitaker-Myers Wealth Managers Question of the Week video. Today's question comes from Sonya in Jacksonville, Florida, and she asked this. My husband and I are in baby step 7. So congrats, Sonya, you've made it to baby step 7, and we're looking into purchase our first rental property. This is new for us. We've never done this before. What rate of return should we expect when investing in real estate? Well, Sonya, this is a question that's on the mind of many aspiring investors, and rightly so, as you need to understand potential returns to make informed decisions. If you don't know what to expect, you can make a really bad decision as it relates to investing in real estate. And investing in real estate is one that if you make some bad decisions, it can not only lower your rate of return, but unlike your mutual fund, it could cost you money. It could make you bring money into the equation. So, first, it's important to recognize that the rate of return in real estate can vary significantly depending on several factors, the least of which might be location. Other things such as property type, the market conditions of the area you're in and the type of property you're buying, and the investment strategy employed. Now, thankfully, you, Sonya, are in an area like Jacksonville, Florida, where you have the blessing of geography. You potentially have a better chance than some of our clients, say, in a place like West Virginia, where there just isn't the population growth happening and they don't have the sun and beaches like you have. One of our real estate partners, Blackstone, for example, they are highly invested in the U.S. Sunbelt because of demographic trends, because of the population growth you guys are seeing down there. However, let's break down some common metrics and expectations as it relates to investing in real estate. Now, one commonly used metric is what's called capitalization rate, or cap rate for short. You watch any video on real estate investing, I just watched some videos from Blackstone, and they talked a lot about cap rates, what kind of cap rates they're getting right now. This is calculated by dividing the property's net operating income, or for short, you'll hear this called NOI, by its current market value. Now, you need appraisal to know that, but you can go to Zillow and get an estimate of a market value. Cap rates can vary by location and property type. So you're not always going to get the same cap rate in every location, but they typically range from 4 to 12%. Higher cap rates generally indicate higher potential returns, but they can come with increased risk. So if I get a higher cap rate, it could mean that the property is just a little more aggressive in property, or I might be taking more leverage on the property. Another important metric is what's called cash on cash return. Okay? Cash on cash return. And what cash on cash return measures is it measures the annual pre-tax cash flow generated by the property relative to your initial cash investment. This metric is particularly useful for investors who are going to finance their purchases with mortgages. So if you're going to take out debt to buy this rental property, you would use this cash on cash. Now, we would argue, do not do that. That's not a smart thing. You can invest in real estate without going into debt by starting small. Talk to your financial advisor about that. But a good cash on cash return is going to vary depending on the investor's goal and how aggressive they are, how much they finance. But those can range from anywhere from 8% to 12% on your ROI. Another way that you can look at how you're going to return on a property is the potential for the property to appreciate over time, okay? It's going to pay you out income, and that income is going to be helpful, that you're getting rent from there, but your hope is that the property goes up over time as well. Well, appreciation rates can fluctuate significantly, and again, a lot of that is based on location. Historical data suggests that an average annual appreciation rate is anywhere around 3 to 5% in many markets. However, it's essential to remember that is not guaranteed. Past performance is not indicative of future results, and that can vary widely based on your location. In a place like Ohio, maybe you've seen closer to 2%, where a place like Florida, you might have seen longer term even higher than that 5% number. So in conclusion, while there's no one-size-fits-all answer to the question of what rate of return should I expect when investing in real estate, those metrics that we talked about, such as understanding the cap rate and making sure that that makes sense, looking at your cash on cash return, making sure that that makes sense, and understanding if there's potential appreciation or how much appreciation you expect to play in the overall rate of return can help set realistic expectations and make informed decisions. And then, of course, Sonya, we would argue you take this back with your financial advisor and they incorporate it into your financial plan so you can see how this helps the bigger picture of generating cash flow, maybe today, but probably more importantly, cash flow when you need cash flow the most, which is cash flow when you have no cash flow, which if I haven't said cash flow enough and run you in a circle with cash flow, it's basically to say when your income stops, when you are no longer working, you need that cash flow from the real estate to help supplement, to help reproduce the income that you're no longer getting from work, but now that you'll be getting from things like Social Security, maybe a pension if you're blessed to have that, and maybe things like your mutual funds and bonds and other investments that you might have. So it's definitely part of the bigger picture. If you isolate that, isolating it helps to make sure that the purchase I'm getting ready to make is a good purchase, and then building it into your overall financial plan is just good to see how it complements everything else you're doing. But let me say this, one of the things we say about real estate, whether you want to do it on your own or you do it through a passive means, which is where people engage a company like Whitaker-Myers to help them invest in real estate through a passive means, we do believe real estate is a good part of a broadly diversified portfolio. Ecclesiastes 11:2 tells us this, okay? We can learn a lot of our investment decisions from the Bible, and it says, divide your portion to 7, yes, even to 8, because you do not know what calamity may come upon the earth. This is one way to build that 7, yes, even 8 diversification that Ecclesiastes talks about. So thanks so much for watching the Question of the Week video. If this video was helpful to you, would you do us a favor? You can do us a favor by going to the like button and smashing it. When you smash it, it helps Google, YouTube, and Rumble's algorithms push our content out to more people so we can help more people experience their worth in Christ through financial freedom, as well as you can hit the subscribe button. The subscribe button will help push our content out to you as we release it for any of our video series. And if you'd like to meet with any of our financial advisors or coaches, you can go to the comment section and hit that button down there, which will take you to our scheduling software. Our coaches will help you in baby steps 1, 2, and 3. Get out of debt, stay out of debt, live debt free, build a budget, hold you accountable. Wow, our financial planners and advisors will help you through baby steps 4, 5, 6, and 7. Save for retirement, save for kids' college, and help pay off that house early or build a plan to pay off that house early so that you can live and give like no one else. Thanks so much. We'll look forward to seeing you next week.